Hello, everyone, and welcome to Weekly for Trade webinar. In this webinar, we're going to take a look at some basic or fundamental analysis. If you have any questions, I would encourage you to go ahead and type them into the question box. So you just pop up the questions or comments, and I will try to answer it as good as I can. So just feel free to go ahead. All right, let's go ahead. I need to start with with a risk disclaimer before we move any further. So trading the CFDs and other leveraged products carries a high level of risk to your capital as prices may move rapidly against you. Be aware, you can lose all but not more than the balance on your trading account. These products may not be suitable for all clients, therefore ensure you understand the risks and seek independent advice. This material does not constitute an offer of or solicitation for a transaction in any financial instrument. Fortrade accepts no responsibility for any use that might be made of the information and for any consequences that results. No representation or warranty is given as to accuracy or completeness of this information. Consequently, any person acting on this does so entirely at their own risk. So, all right, let's go ahead and start now. So, as we already said, in this webinar, we will talk about fundamental analysis. What is fundamental analysis? The importance of financial news. We will look at some high impact economic news events and how we will talk about how to trade the news, which is something quite exciting. So, here is the definition of financial analysis. Fundamental analysis is the analysis of all forces that influence the economy, such as production, capacity, consumer confidence, employment, interest rates, etc. Second, sorry for this. Fundamental analysis is the interpretation of statistical reports and economic indicators, things like changes in interest rates, employment reports, and the latest inflation indicators all fall into the territory of fundamental analysis. Forex traders must pay close attention to economic indicators which can have a direct and to some degree predictable effect on the value of nation's currency in the forex market. Given the impact these indicators can have on exchange rates, it is important to know earlier when they are due to be released. Therefore, you should regularly consult an economic calendar which lists the release date and time for each indicator. So you can find it at the top of your chat box. So we'll now review economic calendar. Just a sec. So here I'm using investing.com calendar. You can find it here on tools. And there's a number of calendars, and we're using, of course, economic calendar. Just click here again. So this is the number, all news published today, and it will be published. So the thing that we are going to do, we'll filter them. So there are all these countries. We will clear it all and choose a number of countries or one particular. And for this example, we will just use for this time United States, okay? So here are the categories of economic reports: employment, credit, balance, economic activity, central banks, bonds, inflation, confidence indexes. So for us in this moment, we'll need them all. Here is importance. So this is not so important. This is medium importance, and this is highly important report. So we will just check this too. Okay. So we will have for today. This was the reports which was published today. Of course, we will here. We will manage the time. So we will use scan Dublin, Edinburgh, Lisbon, and London. This is GMT +1. So there are this is the old reports for US market and US country, which was published today. So we had the core durable goods, and so on. We will talk a little bit more about them by themselves about these reports, but now we will be focused more on what does these numbers actually mean. So these numbers are previous results. What does that mean? This is this for core durable goods orders. Previously, results showed the 0.7% increase. So here is the forecast. This is for now what economists forecasted. They forecasted 0.4 increase, and what actually happened is it is a fall of 0.2%. Okay, so if we click on this indicator here, this means it's opened. So here is description of the indicator. So we can read it, what actually it means. And here is in the second paragraph, it's the influence. So this core durable goods, a higher than expected reading should be taken as positive or bullish for the USD dollar, while the lower than expected reading should be taken as a negative or bearish. So importance again, we choose this one, which is 3 bull's heads. This is the highest importance country, US and US dollar currency, and this is the source who is publishing it. So if you scroll a little bit down, we can see even this graph. So we can use histogram chart, or we can use area chart if you prefer like that. And with this slider, we can adapt time period we actually want to look at. Okay. So if you scroll even further down, we will have this table. So this all results in the past. So today we had this publication for March actually, and it showed 0.24% fall. So if we want to go even further down, we can see as much as we want. Okay. Okay. Let's go back on the economic calendar. So here, what is the most important thing? Because some of the indicators are not so obvious to interpret, like if the number is higher, it's logical in some way to think that it is good for currency, but sometimes, or value of the commodity, but sometimes it's not like that. So for you, it's the most important thing is to focus more on the color than on actual numbers. So if the color is green, that means that this is good for currency. If it is red, this is negative for currency. So for example, today is Thursday, but yesterday we have this report, and this is crude oil inventories. See, the number is lower than forecast, but actually it is good for the price of crude oil, of course, because we're talking about crude oil inventories. So because of this reason, just pay more attention on the color than actually on the numbers, especially if you're at the beginning of your trading experience. Okay, so here you can choose yesterday, today, tomorrow, maybe this week or next week, or you can just choose by date, certain period, or I don't know, specific date. Okay, you can use months here, scroll into tune in the future, or maybe in the past. Okay, so this is about a calendar right now. So let's go back on our presentation. Let's talk a little bit more about high impact financial news. Okay, Fundamental analysis is by itself very, very interesting. So it's very important for everyone just to keep track on what's going on and what is published in economic calendar. So basically, it's very simple interpreting and looking at this calendar. There are a number of forces that influence the economy. For example, when factories starting producing more or less, when they should laying off people, when more people are finding jobs, which increases consumer confidence. All these factors impact the economy, and when economy becomes stronger, the currency becomes stronger, usually. And when it becomes weaker, the currency becomes weaker. Of course, not 100%, of course, true, but most of the time, this is how it works. Fundamental analyst, what he does is he looks at the economy, he looks at figures that are coming out on employment, on production, on interest rates, and based on that, he makes prognosis on the development of the financial instruments, for instance, currency pairs or commodities or shares. So let's go now through some of the most important economic news. So here is central bank meetings and interest rate decision, employment figures, consumer price index, CPI or inflation, gross domestic product. I will pay a bit more attention and focus more on central bank role as its actions nowadays. It has the far most important influence on the currency movements. All the other indicators directly on indirectly influence the central bank to maintain or change current monetary policy with interest rates or other tools. And in this way, directly influence the rates of currencies. So, primary duties of central banks are to implement a monetary policy that provides consistent growth and employment, to promote stability of the country's financial system, to manage the production and distribution of the nation's currency, inform, of course, the public of the overall state of the economy by publishing economic statistics. Fiscal policy refers to the economic direction a government wishes to pursue regarding the taxation, spending, and borrowing. Monetary policy is the set of actions a government or central bank takes to influence the economy in attempt to achieve its fiscal policy. And central banks have several options they can actually use to affect monetary policy, but the most powerful tool is their ability to set interest rates. Most central banks maintain a benchmark interest rate. Depending on jurisdiction, the central bank rate serves as a guide for the rate at which the central bank and other commercial banks lend each other funds to meet short-term operational needs. Commercial lending rates are also affected by the central bank rate. And it is this linking of short-term rates to the commercial rates that makes interest rate policy the primary monetary tool for central banks. The central bank can increase rates during the periods of high growth or high inflation in a bid to reduce consumer spending, which should help bring growth back to a more manageable level. If deflation is a problem and the economy needs a boost, a central bank can lower interest rates to encourage more consumer lending. The expected outcome in this overall consumer spending will increase as consumers have access to less costly loans. So forex traders in particular pay close attention to all changes in interest rates as investors tend to seek out the currency offering higher returns, and this demand can cause a currency to appreciate. Also, the greater the interest rate differential between two currency in a currency pair we are probably trading, the greater the profit potential of a carry trade strategy is. Sorry. So, activities that central bank, which are very important for traders, are interest rate decision. The amount of interest charged by central bank is extremely important to valuation of national currency. If a country central bank set a high interest rate, bearing other factors such as political instability, for example, that nation currency tends to attract foreign assets for countries with lower interest rates. So central bank rate statements. Most central bank issue a statement after rate released, describing their monetary policy committee voting and the reasons the rate was changed or left unchanged during the meeting. The statement could affect the market if the policymakers' voting was unexpected, or if the central bank has a more hawkish or dovish tone for the future rate decisions. So, policymaker and central bank official speeches are also very important. The content of the speeches by the president, governor, or the other official or of the major central bank can sometimes give indications of the bank's future monetary policy, which will often affect the country's currency. Other key policymakers include the voting members of the central bank's monetary policy committee. And while their speeches may not carry the weight of a central bank governor, they could also have an effect on the country's currency, depending, of course, on the content of that speech. And the last one in this list is asset purchase and quantitative easing. So the amount of money a central bank uses to purchase debt securities and other assets to support a weak economy increases or decreases in the amount of the stimulus measures can have a significant effect on a nation's currency because changes in asset purchase can indicate a change in the interest rate and money supply. So, how the change of interest rates or implementation of asset purchasing programs influencing the currency rate? Decrease of interest rates usually have a negative influence on currency rates, pushing it down against the counterparts. In a similar way, introduction or increasement of asset purchase programs and quantitative easing programs also decrease the rates of currency and vice versa. So this was about central banks. Now we are moving to the labor market reports. They're also very, very important. Employment reports have an immediate impact on the currency because employment levels directly affect current and future spending habits. An increase in unemployment is a negative indicator as it implies that more people are not receiving a regular salary. This is a sure signal that consumer spending will decrease at one point. So in this table, this is a list of employment reports by selected countries. So we have here Australia, and the most important employment report is wage price index and measures the changes in wages. In Canada, is a labor force survey provides a snapshot of current employment rates and breakdown of employment by sectors. In the United States, non-farm payrolls, of course, and unemployment insurance initial claims. Non-farm payrolls provides a study of U.S. employment statistics for all workers except those employed in farms or in private homes, and so on and so on. Oh, sorry. So you can see here at the end we have, just to push it a little bit up, sorry for this. And in the United Kingdom, we have claimant count change. This is determines the change in unemployment insurance claims for one reporting period to the next. Okay, back. Go further. Okay. Okay. So we are moving now to the gross domestic product, or GDP, popularly called one of the most influential of the economic indicators. GDP, it measures the total value of all goods and services produced by a country during the reported period. It's usually GDP is quarterly published. An increase in GDP indicates a growing economy, of course, and for this reason, GDP is used to measure the level of inflation within the economy. So we here have like reports for every quarter, and during the as quarter have 3 months, has 3 months. So in every single month we have one revision. So we have the preliminary publishing, and the next month this is the first revision, and in the second month it's the final report, which is actually showing us what was the actual number, actual value of increasement of GDP. So the next one is consumer price index, inflation. Inflation is an increase in price of goods and services. While inflation, by its very definition, suggests economic growth, inflation can occur too rapidly. If it occurs too rapidly, actually weakens customer buying power, as prices increase at a faster rate than their salaries. So just go back and to explain what exactly is CPI, or consumer price index. It measures the cost to buy a defined basket of goods and services. By comparing results from one period to the next, it is possible to measure changes in consumer buying power and the effects of inflation. Inflation is a concern to currency traders as it affects the price of everything bought and sold within one economy. And this has a direct impact on the supply and demand for country's currency. Federal Reserve, Bank of England, as well as ECB, European Central Bank, put 2% as their targeted value. So now, what is more important, technical or fundamental analysis? Many people ask this question, what is more important, technical analysis or fundamental analysis? Technical analysis, we're going to look at some some of the next webinars, and it is no doubt very important, but many beginning traders seems to think that the technical analysis is the only thing that counts, that fundamental is not needed at all. This is a big mistake. As a matter of fact, the most successful traders, forex traders, use both. You need both. In some moments, technical analysis is maybe more important for many people because it makes analysis of the market much easier, but you should never lose track on the fundamentals of the economy or a company, even if you're investing in company or stocks, because if you do, you're likely to end up on the losing end. That's definitely. So financial news actually has news have both real and speculative value, because it on one hand, financial news actually says that coming about how the economy has reformed and probably will reform in the near future. On the other hand, traders also react to the news, and so even though it says something about how the economy functions and how the government will probably what kind of measures that will be taken in the future, there are also traders who react to the news, and this accounts for the speculative value, because reaction on the financial news often starts even before the news is out. And actually one of the most famous expressions is the trading is, you probably know it, buy the rumor and sell the news. This is exactly because traders start speculating on what the news event might be earlier. So for instance, when Federal Reserve is about to have a press conference in coming days, and there is a rumor that the interest rate will be probably be increased by the central bank because they want to normalize monetary policy, then you will see that in the days leading up to the event, traders will start taking positions reflecting that probable decision or possible decision. Now, the funny thing is, of course, that when the decision is actually made and went out public, and it turns out that Federal Reserve indeed does increase interest rates, it's quite possible that the price of the financial instruments, the price of, for instance, euro-dollar currency pair, moves opposite direction you expected, because the price was already, in some instance, or decision was already priced in. Everybody Everyone already thought the euro is going down because and euro dollar is going down because the Fed is going to increase interest rate. So in the days coming to it, leading up to the event, the euro indeed was going or is going down. But then when decision is made public, people or traders tend to think, oh, okay, so now we had it. I'm going to take my profit. I'm going to get out of this market. So this actually making the euro dollar actually goes up. And it happens a lot. Impact on the financial news. It's important to realize that, especially if you're a short term trader, you should keep a watchful eye on the financial news because unexpected news can hurt your position. Imagine this: if you're a trend trader and you're you wanting to stay into the trend for years, and you're in already for a long time, and you have a stop loss which are far away. Let's say that you're in, for example, just in a Australian dollar Japanese yen, which is moving up, for example, and you want to stay there for years. Then, if the price of the currency pair drops 50 pips, it doesn't matter really for you because your stop loss is further away, because your profit targets is also further away. But if you are a short-term trader, if you are intraday trader, for instance, with a profit targets of 70 pips and stop loss of 30 pips, then news events can stop you out like that in a moment, very quickly. And because if a news event comes out like non-farm payrolls in the US and unemployment figures, interest rate decision, consumer confidence numbers that are surprising, your position could easily be stopped out if it's only 30, 40, 50 pips away. So keep an eye on it. And if you don't want to deal with this particular news events, those high impact news events, simply, just close your position before event and open it afterwards. So it's not just, of course, these economic reports that are having impact on financial markets. Geopolitical events also can make strong movements, and with the geopolitical events, consider wars, elections, power changes, natural disasters. So for wars, for example, the breakout of a war, ceasefire significantly affect the valuation of a currency issued by the nations at war. And sometimes, depending on what countries are involved, the forex market can be impacted in general. Wars can also significantly affect commodity prices and other assets produced in the nations involved, thereby affecting the currencies of other countries that produced similar assets. For elections, for example, change of regime or political majority can significantly affect the value of a nation's currency. If the incoming government favors capital incentives and lower interest rates, the value of the currency could be negatively affected. Other types of popular votes can also significantly affect the valuation of a currency. For example, a referendum on a country's exit from the European Eurozone and European Union, like it was with Brexit, substantially impacted the value of the pound and in euro in some instance. Power changes in nations that can have the change of power, such as forcible regime change, could experience a complete revaluation or devaluation of their currency. National disasters, again, when a country is hit with a substantial natural disaster, that nation's currency typically appreciate in the short term due to the need to more money for disaster relief. Nevertheless, in the long term, the currency could be adversely affected if the natural disaster has a considerable negative impact on the country's economy. Trading the news is very popular with some people. It's fun because the important financial news have a big short impact on the currencies. So you can immediately get into the trade and make a splash and get out again. So that's fun, but also you need to know that it comes with strings attached and you have to be very, very careful. The impact of the first 90 minutes is is the highest after the dissipates and afterwards dissipates usually. It's highly speculative, so don't expect, especially in the beginning, once you start doing it, don't expect that to make money on every trade. It will take a while, so it's good if you make money on average. So only open position when you see a clear direction. Doesn't matter which way the direction is, but you have to have a clear direction. So this would be some couple of very important points. Just keep all of this in mind. Okay. So if you have any questions, now would be a good time. Okay. Okay, no one? All right. We have then reached the end of our time here. Thank you very much. And just want to wish you all the best luck in your trading and have a great week. See you soon. Talk to you soon. Bye now.